about debt and interest rates and how this all plays together. It's kind of a complicated beast, but we'll just kind of go over, you know, the parts that we can. This is gonna be pretty basic, but again, if I'm going too fast, just let me know and we can slow down. But debt, right? So there's different types of debt. All debt is not bad debt. There's good debt, and then there's, you know, not great debt, right? So you have the personal loans, you've got mortgages or debts, credit card debts, student loans or debt, car loans or debt. These are all debt. But usually there's a different category because all debt's not bad. So having a mortgage is technically usually not considered bad debt. That's considered good debt. But why is it considered good debt? Not just because everybody does it, right? It's because you're investing in something, you're taking on debt to invest in an asset that is going to appreciate in value, right? An education loan is generally considered the same. A loan to go to college, for example, is going to be income generating debt because the idea is you invest in yourself, you invest in your education, and then you'll be able to increase your income, and then you'll be able to pay back that debt. And so the ROI is very high. The same goes for business loans, right? So you get a business loan from the bank, they'll give you $20,000 to start your business. If you give them a business plan and show them why you think that you can turn that money around, make a profit, and pay them back, right? So these are all good debt. Good debt is basically when you think that the debt you take on is going to help you pay it back with more money. The ROI is high. So then you have the bad debt, which isn't always bad because you also sometimes need this. Like sometimes taking on debt while your education is in process or your business is in process, you know, or like you haven't quite gotten to where you want yet. Like you can take on other debt, right? So this would be like credit card debt or car loans even. I would consider a car loan kind of in the middle, but depends on if the car is going to be income generating or help you achieve more income. Like if it's a car that gets you to your job, or if it's a car that you're like driving for Lyft or Uber, right? This could be good debt, right? But if you're buying like, you know, the latest Tesla, but it's just going to sit in your driveway and you take on a ton of debt for that you don't have the money to pay it back, then maybe that's bad debt, right? Same thing goes for like other luxury items. Like if you're taking on debt to borrow money to like buy a boat that's just going to sit in the ocean, right? That's probably not like great debt. And then payday loans is on here too. Like people who don't have enough to make, you know, month to month, kind of paycheck to paycheck, can't even get to their next paycheck. They'll take on debt to get money now with the expectation that they'll use their paycheck to pay you back later. But that's a slippery slope. So we consider that technically bad debt as well. But I did want to get it drilled into everybody's mind that debt in general is not bad. It's just how you use it and how you think about it. So then simple thing about interest. So when you see an interest rate and somebody says, oh yeah, it's going to be 10% interest, it depends on how that interest is calculated. So if it's simple interest, then it's just, so if you borrow $100 at a 10% interest rate, then and it's simple interest, right? Then you would just be paying 10% of that $100, which is $10 over the course of 1 year. If you're talking about a 10% annual interest rate, which is which is the most typical. But then compound interest would be like if it compounds every month rather than every year, and then that interest is actually going to be much higher. So this can happen when you're talking about mortgages or car loans. Like, that's not really simple interest. So a credit card might advertise 12% interest, but then when that's compounded annually, it actually becomes like 12.68%. So that's the difference between like an APR or an APY. So the APR is the simple interest number, and then the APY, which is the annual percentage yield, is going to be what that compounded, that's the true interest that you're paying on it per year. So that's always good to keep in mind, because you have to kind of ask if they don't necessarily say, because sometimes they don't say. And I found this as I'm looking at loans right now, and they'll say, you know, they'll be like, oh yeah, it's 6.75%. And then they're like, oh yeah, but like APY is like 7.1, you know, which is a big difference when you're talking about large numbers like mortgages or a $50,000 car. You know, that can increase your monthly payment quite a bit more than you expected. And over the term of the loan, it can be a lot more than you expected. So I'm not going to go into the math about that. That's boring. But just keep that in mind. Yeah. And then we have fixed interest rates and variable interest rates. And so the fixed interest rate is just, it's going to be the same for the entire length of the loan term. And then the variable rates does not mean that they're going to tell you when the loan rate changes. It's just going to change. And so it could be that let's say that in 2022 or 2021, that you got a variable term loan and the loan was at 3% interest, but it was variable. And then interest rates rise, and now your 3% interest rate is now like 8%. That's what can happen, because it's based on other interest rates, and they won't tell you. It just changes. Versus, let's say last year you got a loan and it was a variable rate loan at 8%. And then over the course of the year, the interest rates dropped, and now your loan is now at 6%. That can also happen, right? And so it just kind of, it will vary over time depending on. So generally speaking, it's probably not wise to get a variable term interest rate for a long-term loan. This is why mortgages tend to be, they're 30-year loans usually. And so you don't really want a variable term if you don't know where interest rates are going to be in the next 30 years, and you want a stable monthly payment. But variable could be good if you know that interest rates are going to go down and it's just like a 1 or 2 year loan, you know, something like that. That may be not a bad idea. Or if you have more flexibility in your budget. But generally speaking, when you need like to know what the monthly payment's going to be, this is why most people go with fixed rates. Okay, so so how are interest rates actually set? Like, why are the interest rates what they are? Why are they what we see? So there's something called SOFR, which is it's the secured overnight financing rate, which basically it means like it's the rate that banks loan overnight to each other, which is kind of a weird thing, and I don't exactly understand it, but that's sort of like the benchmark for variable interest rate loans. So if you're ever curious, if you're looking at a variable interest rate loan and it says, oh, it's going to be, 6.75% variable, and you're like, okay, but like, how much are we talking? How variable is it going to be? Usually it's based on SOFR. So you can Google SOFR rates and you can actually see a chart of like what that interest rate has been changing on a day-to-day basis. And that interest rate will change on a day-to-day basis. And so you can kind of see like, okay, well, what's the history? Where's it been? How's it been moving? Has it been moving a lot, a little, that kind of thing? You can kind of look at it and see. So if you looked at that recently, you would see SOFR has come down a lot in the last year. But it's also not stable. And so this is related to the federal funds rate, which is what the feds determine the interest rate at. But the federal funds rate stays the same for months at a time, whereas SOFR adjusts based on that, but it can still vary day to day around that number. So things that use SOFR are going to be like the adjustable rate mortgages, business loans, credit lines like HELOCs, where you take a home equity line of credit. So if you have equity in your house and you just want to like have a line of credit against that, usually those are going to be variable interest rates. And it's going to be based on this SOFR number. Student loans, also based on SOFR. Derivatives are just complicated. We don't need to talk about that. Credit cards, also based on SOFR. So if you pay off your credit card like every month, this doesn't really apply to you. But let's say you're carrying a balance on a credit card, it does apply because that's not a flat interest rate usually. Credit card interest rates usually are variable as well. So then we have how you make interest, which is kind of a fun idea. So interest rate is because if you are borrowing money from the bank, they're going to give you money and they want a return on it. So they say, we'll give you $10,000, but we want 10% interest on that for the risk of lending you this money. And so you then have to pay them interest, pay it back with interest. But the same thing happens when you loan money to the bank. So when you actually deposit money into your bank and they're paying you a 4% yield on it, right? What you're actually doing is you're loaning money to the bank because they then take that money and they loan it out to somebody else at a higher interest rate. So by storing your money in the bank, you're letting them borrow it, and that's why you get a return on it. Because you're the one loaning it out, and you should get a return for the risk of they may not pay you back, right? The risk is very, very low, but you're taking on some level of risk by doing that. Yes, mother. Technically, what this is called is rehypothecation, which means they take your money and you think that it's just sitting in the bank, but it's not really. This is not how banks make money. They don't just keep the money in the bank doing nothing with it. They rehypothecate it, which means they take it and then they package it up and they let other people borrow it. So what I would check is that there are some banks or some types of banking accounts where they do not rehypothecate. And this has actually become, I don't want to say a point of contention, but a point of debate I would say, about how much banks should be rehypothecating and what is reasonable and what is safe and what's too risky. So if your checking account is like giving you 0.01% interest, they're probably not rehypothecating it, right? It's just, that's the money that they actually are holding. Your Wealthfront account, where it's giving you a 4% yield, they are rehypothecating. They are loaning that money out. Same with your high yield savings accounts, right? Those are getting you interest because they're lending that money out. It's not really a transparent thing. You could have banks that are giving you basically no interest and they're still rehypothecating. And rehypothecation is very common. Like this is just how our banking system works right now. But whether or not you think that that's fair or that they should, that is, I think that's what's up for debate. And you also, as the client, right, you have the right to choose where you put your money and which banks you trust with that. This is why it's also important to know if you have your money with a particular bank and you know that they're rehypothecating, you might want to know what are the terms of their rehypothecation? Like, how much money are they lending out of their accounts? Are they going to be solvent if a bunch of people take their money out? This is how things like Silicon Valley Bank have gone bankrupt. That's the point here, and that's like the point that I would drill home, is that if your bank is lending out your money, you should be earning a return on you taking that risk, right? So returns are always based on high risk, high return, right? Like, it's not always, but right. But if you're taking on high risk, you're only going to take on that high risk if you have the possibility of high returns, right? If you are putting your money under the mattress, right, you're not really taking on any risk. So that's why you get a 0% return on it, right? And if you put it in the bank and you expect that it's just going to sit there and do nothing and that it's the lowest risk possible, it's understandable that you would not get any interest on that money. But you are right. If they are rehypothecating that money, then you are actually taking on more risk. And if they're not paying you appropriately, then you should move your money. So generally, most checking accounts are not interest bearing. So this is something that I would pay attention to. And then all these high yield savings accounts, they definitely are interest bearing. And right now it's 4 to 5. It's like 4 to 4.5 depending on the bank, right? But again, like Rihanna said, that is also it's not a constant thing. So the interest rate that you get in a high yield savings account is variable and it's tied to SOFR, which we just talked about. So if SOFR goes down, then the interest on your high yield savings account also goes down. And then when we talk about the retirement funds and investing, this is the same thing. This is you lending money in the form of bonds. So when you buy a bond, you are actually lending money to the government. And they're saying, cool, when you buy this bond, we're going to take that money, we're going to go use it for, XYZ government stuff. And then we're going to give you a 2, 3, 4, 5% return on that, depending on the level of risk, right? Because some bonds are like short-term, some bonds are 10-year bonds. And so a 10-year bond, you would expect, gosh, I'm tying up my money for 10 years. I better be getting a pretty good return. But they're not. You can get the same interest rate on a 1-month bond that you can get on a 10-year bond right now, which is why nobody's buying 10-year bonds and everybody's buying 1-month bonds. You can buy a 1-month bond and get a 4.5% return per year. But then it's also, when you buy a stock, you're basically lending your money to a business and saying, hey, yeah, I'm going to give my money to you because I think that you can get a return on my money. And then they pay you back with the return of the company or with dividends. It's not technically lending, right? Because you're buying a share in the stock, right? And then you're getting a return. Some of them will give you a dividend. Other companies do not. So if you buy a share of a stock that is a dividend returning stock, then you do get those dividends. If you don't, if you buy like Airbnb does not pay a dividend. So if you buy a share of Airbnb, it's technically kind of higher risk. And so you also, because you're not guaranteed any payment. You're only guaranteed a return if the company does really well, and then you sell it. But if you buy it, then you're giving your money to that company, and then they get to go use that money, because the money that you invested, you're investing in that company, and then they use that money. Yeah, this is kind of complicated, but like, okay, so like MicroStrategy, for example, or they're now called Strategy. So Michael Saylor turned MicroStrategy into a convertible bond business where basically you actually buy a bond, and he promises he actually just released a new bond where he promises 10% on these bonds. You buy a MicroStrategy bond. He promises a 10% return on that bond. And even if it doesn't go well, right, he doesn't pay the 10% on the bond, but you still get your capital back. Okay. Related to last week's tax deductible conversation, Mom was having a question about this, about mortgage interest being tax deductible. And mortgage interest is tax deductible, right? But only if you're itemizing. So if you take the standard deduction, then you're not going to also be able to deduct your mortgage interest. So it kind of depends on how much your mortgage interest is. So for me, my mortgage interest is really high, right? It's at the peak, it was $50,000 for the year. So for me, deduct my mortgage interest because it was way more than the standard deduction, right? So when you were talking about, well, why are some people deducting and they're itemizing? Like, should I be doing that, right? The answer is, well, how much is your mortgage interest? $3,000 a year, maybe? If your mortgage interest is $3,500, it's not really that much. So you're not really going to benefit by itemizing that mortgage interest. It would be better for you just to take $30,000 for the standard deduction, right? But other families who maybe have $1 million house, they bought them at, the high interest rates, then they probably do want to itemize their mortgage. So mortgage interest is deductible. Business loan interest is deductible. So if you got like a business loan from the bank, then the interest on that business loan, you could then deduct that on your taxes. That's tax deductible. And then even investment interest. So if you're like taking out a margin loan, or your, what else would it be? You've taken on some loan from the bank that's not really a business loan, but it's like an investment loan type of thing. Then that interest, if it's being used for investments, business type stuff, right, then you could also deduct that from your taxes. So I'm not saying that anybody should necessarily be doing this, but it is, I think, valuable to understand like how you can actually use this to lower the true interest rate, right? Because then credit card interest is not tax deductible. Auto loan interest, not tax deductible. Personal loan that you take out, like a HELOC, that interest is not tax deductible. Always check with your CPA. But like generally speaking, anything for like personal use is not going to be tax deductible. So that interest is just the true interest, whatever the cost is. But if you're saying I took in a mortgage or I got a business loan and interest was 7% or something, you have to also consider, okay, well, I'm going to be paying 7% interest on that, but it's all tax deductible. So what is the true cost? Does that make sense? So that's
Yes.
kind of why our tax code is incentivized for people to start businesses, and it's incentivized for people to get mortgages. So the federal funds rate is set by the Federal Open Market Committee, the Federal Reserve's FOMC. So this is a committee of, I think there's 8 of them. I'm not exactly sure how many of them, but there's like a group of them. There's a committee. They meet 8 times per year. And they sit around the table and they look at what's going on with the economy. They look at the market. They look at inflation, right? But so when we were talking about leading and lagging economic indicators, one of them we talked about was that the Feds, what economic indicators do the Feds look at?
They look at unemployment rates.
Yeah, they do.
And they're setting the interest rates in order to do that. They are not looking at the CEO stuff. Those are like leading indicators. They're looking at lagging indicators, right?
Yes.
So that would be the unemployment, and then what was the other big lag? Inflation?
Yes, inflation. So this committee that we're talking about, the FOMC, they're looking at those lagging indicators of the economy to decide, should we lower interest rates or raise them? Or should we just kind of like keep things where they are? Because if they lower interest rates, what does that mean? People are going to borrow more money. There's going to be more money in the economy. So it generally stimulates the economy. Right now, if inflation were to rise, then they would need to raise the interest rates to get inflation down. But if inflation stays low, the point is the Feds, they're looking at all these lagging economic indicators to determine how can we either stimulate the economy, affect the market to with interest rates. That's like a tool that they have in their tool bucket.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady.
So these are the types of meetings that move the market and move interest rates. And then once these interest rates are set, right? So they just said they're going to keep interest rates the same. So essentially we shouldn't see any like drastic changes based on that. But even if they were to lower the interest rates, right, then that would be seen as like, oh, this is good. It's optimistic. It means more people are going to be borrowing money and spending money, and this is generally like good for the economy kind of thing. If they raise interest rates, the market tends to not like that, right? They're like, oh, borrowing's going to cost more money, then the banks are going to make less money because the margins aren't as good, you know, things like that. So the interest rates make a huge difference. And so Jerome Powell, like whenever he gets on the TV and he has this meeting, people are paying attention very closely. This is the real-time federal funds rate. So this is not the SOFR rate, right? This is the federal funds rate. So what Jerome Powell and the committee have determined what they're setting the base Fed funds rate at. So right now it's at like 4.35. Yeah, it hasn't really changed since the last meeting in the winter. But then you can see where the interest rates were very high. So the interest rates were up to like 5.3 between August 2023 and August 2024, and then they started bringing interest rates down. And then you can see where they raised interest rates very rapidly in 2022 to try to control inflation. Now inflation is under control, so now they bring interest rates down. Then we can look like historically, there's this period here between, let's see, so, right, so in March 2020, we were having a brief recession. And so interest rates were, 1.5 or so, which is still pretty low. But to stimulate the economy, they dropped them immediately to 0. Interest rates were 0. Well, the Fed funds rate was 0. And it stayed that way pretty much until February of 2022. 0% interest sounds good. It stimulates the economy, but it also means that your mortgages are at very low rates, right? Which is cool. But it also means that, what else does it mean? It also means that bonds are not really returning anything. So they're not really good investments. You weren't getting any, you store your money in the bank, you didn't get anything for it. You got 0. Right? So basically it stimulates the economy because there's no point of you holding money in cash or in bonds because you're not getting any return for it. It's practically more risky. So it stimulates the economy to say, take money out of cash and bonds and just start spending it. It's more useful that way. Until the golden years ended in February of 2022. We're a little overheated here. We've got people spending way too much money. The market's doing way too well. Inflation's way up. And that's when they had to start raising interest rates. And then if we go back, so then when we go back in time a little bit, you can kind of see that for the last since 2008, interest rates have been relatively low, except for this other brief period in 2017, 2018. But even then it was only 2.4, whereas then it doubled this last time. So interest rates have been historically very low. Interest rates were also like close to zero from the financial crisis until 2016. So this is not normal. If we look back at other periods of history, interest rates go up and down. We had interest rates up to 6.5. That's even higher than they were this time. It only got up to 5.3, right? In the 1980s, we had really, really high interest rates. Like if we think we have high interest rates now, it was nothing. In the 80s, we had mortgage rates at 18%, credit cards charging over 20%, but also bond yields were producing 9 to 15%. So you could put your money in a safe bond and get 15% return on it per year, which is cool, but also the cost of borrowing was much higher, right? So, a 6%, 7% mortgage seems pretty reasonable when you look at the historical context of other periods of time when you had to buy a house and it was 18%. How much were you paying per month for that property? So it's not so bad now. Now we have the problem of high real estate value, but back then is interest rates. And so it was pretty high. It went up and down. And then the 2008 financial crisis, right? We really had to stimulate the economy. And so then they lowered rates dramatically to these historic lows. So they went from this historic high to this historic low. And then as we saw, it kind of went up and down a little bit. But then in 2020, they went to the lowest of lows, and they were the Fed funds rate was 0. And so the mortgage rates were on average 3%. And that the spread between the Fed funds rate and the mortgage rate or the auto loan rate, that's the spread that the mortgage company or the bank actually is making on that loan. So 3% is actually pretty common. Like 2.5%, 3.5% is kind of the spread that banks are looking to get when they loan money out. So if the Fed funds rate is at 5.3% and the bank wants to make 3%, then you have to add the 3% onto the Fed funds rate of 5.3. So now you've got 8.3. So that's why when you saw the Fed funds rate at 5.3, mortgage rates were at like 8.5. So a mortgage below 3% was unheard of. And if you could have locked that in at a fixed rate for 30 years, you did amazing. Maybe if we were used to 0% interest rates, then 2.5% seemed high, right? But it will never be that low again, as far in our lifetime, probably. Right. And credit card loans were at like 14 to 16%, but then bond yields also bottomed out. So basically, if you had any money in bonds, you weren't getting a return, and the value of them doesn't go up. So this is kind of also honing back to our conversation before about why bonds have kind of like, for the last decade, people are like, why do we even have our money in bonds? They have returned a 0% return. And then when interest rates did rise, when interest rates rise, that means bond yields rise. And when bond yields rise, the price of bonds go down. So even though it was not getting a return, it started to get like a 2 to 3% return, but then the price of the bonds dropped so dramatically that you lost your principal. So it was a lose-lose situation, and this is why a lot of economists are wondering, what's the replacement to the bond situation due to the current economic climate? You know, bonds aren't really like the safe haven that they used to be. So bond yields are back up, but at 4.5%. Yeah. Yeah, and then that brings us to now, where we've had the rapid rate increases, and then in the last 6 months, they've started to lower those interest rates again. So that was the 80s, really high interest rates, 20% Fed fund rate. Right. So you can also see that it cycles, right? So it goes between periods of low to high, low to high, low to high. So you can kind of see these cycles happen over time. I think it goes all the way back to 1955. All right. Since we had some questions before about cash versus financing, I thought we would throw in a little short convo about that. So like my example of I bought the car in cash because I thought 2.5% interest was too high. So let's use a fictional $35,000 car because that's pretty typical. So if you pay for this car in cash, right, you're not paying the interest that you would pay on that car loan. But now you have the hidden opportunity costs, right? So now you don't have this cash. It could be an emergency bucket, just some liquidity, you know, that kind of thing. The other opportunity cost is if you were to hold it in investments, it probably would return a lot more than the cost of the interest on the car loan. So then you have that opportunity cost. I think in the bottom left, at 5.9% financing, which is pretty standard right now as well, $35,000 auto loan, it would cost $5,500 in interest over 5 years, versus investments could yield like $10,000. So you'd actually come out $5,000 ahead over 5 years if you had financed the car. Of course, this 100% depends on if you're going to finance versus cash. You have to know how you're going to, what the plan is for that money if you're going to take on the loan, right? Because if it's just going to sit in cash, it's not really earning a return, but maybe it's also the peace of mind of having this cash available for emergencies, you know, rather than eating all of that emergency money up right now. And then but on the flip side, there's also the peace of mind that if you buy it in cash, then you no longer have a car payment and you don't have to worry about having this loan in the back of your head, and you know that you just own this outright. Then the other thing to consider is that some cars and like car dealers, they'll give you like promotional financing. So they might say like 0% interest for the first 36 months or something, and then what's the interest rate after that? But you can always refinance car loans as well. So to take like a 0% interest for 36 months, I mean, to me, that's like a no-brainer, right? So yeah, always check for promotional interest deals when you're making large purchases. I'm sure you all know there's also 0% interest credit cards. Usually you can almost always get a 0% interest credit card for 12 months at a minimum, if you have a good credit. those are pretty easy to get as well. So if you were gonna like, oh my gosh, I have to like buy a washer dryer because mine broke suddenly and I don't have the money for it, you know, you could get a 0% interest credit card, put it on that credit card, and then like pay it off over the next 2 years even. Things like that, versus trying to find the cash to pay for it right now could dry up your entire emergency fund, you know, very quickly, things like that. So we're going to talk about credit scores next, right? So
Okay.
So credit scores matter when you're trying to borrow money in a traditional way. I say traditional as in, you know, you can do private deals with banks and they don't necessarily care about your credit if you have other assets to put on the line, right? But if you're trying to get a traditional mortgage, a traditional business loan, a personal loan, a HELOC, your credit score matters a lot. And it doesn't just determine how much money they'll give you, but it determines at what interest rate. So pretty much right now, if you wanted to get a 30-year mortgage right now, if you have excellent credit, it would probably be between 6.5 to 6.7. But then as it goes down, you see that the interest rate goes maybe up to 7, maybe up to 7.5. And then really bad credit, your mortgage is gonna be like 8.5 or above. It goes for car loans and mortgages as well. So yeah. So I think I don't know where it got this number from, but probably approximate. But if you look at the difference between maybe 6.5 and 8.5, right? That's like 2% difference on, you know, I don't know, a $400,000 house, 2% difference over 30 years. You know, this can save you hundreds of thousands of dollars in interest. So it does pay to have better credit. If you just have assets, but you don't have income, it's going to be a lot harder to get these loans. Basically, you have to go through your bank and you have to get a loan against your assets or an asset depletion loan. So they actually put your assets up, but that requires that the bank actually hold the asset. So then you have to actually transfer the assets to the bank. Then they hold those assets in custody, and then they will loan you money against that. They don't care if you have income. They don't care what your credit score is, because they hold your assets. And if at any point in time you don't pay that interest, they just sell your assets and take your assets. So they're not really taking on a lot of risk. Better interest rates because they're not taking on as much risk. And the other thing falls right into my next slide, which is the interest rate gap, or like the spread. So the spread between the rate that you can borrow money at versus the return on investment that you expect to get on that money. So this is basically like a business loan. So you would go to the bank and you would say, hey, I want a business loan. Great, we're going to give you a business loan at 6.5%. And then you say, great, I'll take that at 6.5%. I'm going to invest it into my business, returning 11%. And now the business owner nets a 4.5% return on that borrowed money. So it's strategic borrowing, right? So you're leveraging low interest loans against assets, is what I was just talking about. So that also prevents you from having to sell the assets and pay capital gains. And then you're just paying interest instead of capital gains, which is lower than the capital gains tax rate. Yeah. And then if you're reinvesting that into something that makes more than the interest rate, you earn the spread, the difference between that too. So it's strategic. It's using debt strategically versus the other type of debt. The other type of debt is on the right side, right? So generally, this is people with lower income or lower credit scores. You're going to face higher interest rates. And because you don't have the income, they can write deals that are more predatory and less favorable for the borrower because they tend to be more desperate for the money. Or they may not have relationships with certain banks and they're using payday loans, you know, those like corner stores where they're like, yeah, I'll give you this loan and I'll give you your paycheck ahead of time, but you're going to pay 20% interest on that because they can, because people are desperate, right? Or the loans, like on a car loan, could cost 5% more for a lower income borrower, and they're going to pay more on that car loan, which means their monthly payments are higher, which means it's harder for them to get their monthly expenses low, you know, whereas the same car for somebody who has higher income and better credit could be paying less per month for that same car value. So, yeah. And then a lot of low income people might be getting like a 15% car loan on an expensive car that they can't afford, which then depreciates 15% per year, because most cars depreciate on average 15% per year. So now you are borrowing money at high rates to acquire an asset that depreciates. And so now with that, you're actually losing 20% per year on this asset that doesn't return you anything. So that's sort of the true cost of borrowing money to buy an asset that depreciates. Strategic borrowing is not just for the Elon Musks of the world. I mean, I do this. Most small business owners do this. Most upper class Americans do this. I wouldn't say that this is like uncommon. It's not just the Elon Musks of the world. It's just strategic. It's just a business strategy. But if you're in the middle, let's say you're not doing any strategic borrowing, but you're not, but you have good income and good credit, well, then it's just kind of boring because you're getting a good interest rate and you're borrowing money, and then you have the income and you pay it back every month, and you are slowly building your wealth. There's not really anything interesting to say about that other than you're doing great. Well, when you think about somebody going to a bank asking for a business loan, yeah, you may not do that. I've never done that because I don't have a business idea that I want to go to the bank to get money for. But let's say I wanted to open a taco shop in Raleigh, and I needed the money to build out the space and build out the restaurant, you know, like, or just say any restaurant. So I'm a business owner and I want to build a restaurant. I have to go to the bank to get a business loan. Most small businesses do fail, but the banks still lend them money because they lend to enough small business owners that some of them do make money, but some of them fail. So yeah, you can't really ever guarantee, even if you go to the bank, like you're submitting them a proposal, like you're giving them a business plan, you're saying, this is my plan to make money, but like you can't ever guarantee that it's going to work out that way. And also, I think what you're thinking is like, you're saying, well, a lot of people don't do the strategic borrowing, but actually every homeowner does strategic borrowing. Anyone who takes out a mortgage, because you're basically saying, hey, I want to take on a ton of debt and I promise I'll pay you back because I have income and I'll pay you. And then as the house appreciates, if I ever sell the house will appreciate in value. And so now I'll pay you back when I sell it. And then I actually make money. So you are earning the spread. So everyone does it. It's just that mortgages are more, they're more common. They're more acceptable. This is what it's the only debt really that seems to be like the socially acceptable debt to take on, like to take on huge amounts of debt to buy real estate. Generally because it's generally very safe, right? But then we found out in like 2008 that maybe it wasn't. And that was the entire housing crisis, was that everyone was taking on huge amounts of debt and over leveraging themselves and buying houses and taking on debt that they actually couldn't really pay back, that they were hoping that they would pay back when they sold the house. When the property values decreased, they realized, oh shit, I actually don't have the money for this. And then all those houses got foreclosed on because people couldn't actually pay it back. But yeah, it's like socially acceptable debt. And the student loan debt is another like huge one, where like student loan debt is also socially acceptable debt because it can be good debt if used strategically, right? But if you go and get a degree from a university and you come out of school with $400,000 in debt to get from an archaeology degree, and you're like, I'm going to go work at the museum making $40,000 a year, not a very strategic investment. And unfortunately, that is what's happened, is that a lot of like Gen Z and millennials took out huge amounts of debt for their college tuition and came out with they didn't even come out job ready or with careers. They just came out with more knowledge, and they're not job ready and they can't get jobs now. and so they can't pay back these loans. So this is not strategic debt, right? Does that make sense? But if I were to go back to school and say, like, this is just a funny example. Let's say, okay, so we're going to the AI generation. Let's say that there was a new certificate that came out and it was like, we're going to teach you everything you need to learn how to like succeed in the AI generation. And you're going to come out like job ready to train AI robots or something, right? You'd be like, yeah, I think I'll take on $20,000 of debt to do that because I'll probably be able to make tons of money after that. That would be very strategic, right? So successful people, I mean, like successful financially, you'll see that they generally have invested a lot of money into themselves, into their careers, into their real estate. You know, they put value into something and then it returns. And this is why businesses are valuable, because you borrow money to then create something of value that your community needs. Like, I really want this Mexican restaurant to open across the street. And like, if they open, I'm going to go spend all my money there, right? And then I'm getting value from chips and salsa, you know? And so they're going to be paid and get that ROI, you know? So it's better than just, you know, taking on debt to get a shiny new car. That this is no flack about, maybe we shouldn't talk about cars anymore. Let's say like, oh, I'm going to finance his jewelry because I really want it. But the thing is by doing that, you're actually taking value out of the economy. You're not really like putting value back in. So in my head, I like to think of it as like, if I can take on debt to then create value, that seems like good debt. if I take on debt to take from something and take value out of the economy, I shouldn't be taking on debt. I should just pay for it. Which actually brings me to what I wanted to close with, which was this. I think this is just so ridiculous, and maybe you guys have seen this. Have you guys seen this deal DoorDash did with Klarna? This is the buy now, pay later trend, where you've probably seen, like, if you buy something on Amazon or your credit card, it'll be like, oh, buy this now and you can pay in 4 easy installments, right? That's cool if you pay it off within those 4 payments, right? But a lot of people then don't, or they miss payments, and now they're paying a ton of interest. But Klarna is this company that finances short-term purchases like this. So you can buy now and then pay over 2, 3, 4, 5, 6 months. You pick the terms of how much you want, and for small amounts, very small amounts, you could do this for like a $50 item. And they just did a deal with DoorDash where you can now buy now, pay later on your DoorDash food delivery. And there's a lot of talk right now about how this is probably not good for the economy and not good for budgeting. It is not good. This is bad debt to take on, guys. This is bad debt because you are basically just saying, I want to live a luxurious life and I'm just going to pay for it sometime in the future. It's pretty ridiculous. And they've been getting a ton of flack for it. And they're, of course, the marketing teams are just like, oh, but you can buy more than just burritos. You can buy things at convenience store. Like, yeah, it's not a good direction. Anyways, that's where I wanted to end on our debt, where we've come from financing large purchases like houses to financing $10 items, which, yeah, it's concerning. That's bad debt, guys. And that was it.